Today, we want to talk about the current status of mortgage rates and its impact on housing prices. And as we dug into that conversation, it turned out to be a deep rat hole that we're going to explore today.
Yes, our goal is to discuss just mortgage rates, but housing prices affect things beyond just the mortgage rates. The status of mortgage rates have been very uncertain lately. We've been in a very low interest rate environment for a very, very long time. We've actually fallen below 2%, something that has been unprecedented. And we then hit the high twos to low threes as of January. And here, as of late June, we're hovering around 5.5% to 6%. Mortgage rates have literally doubled. I don't think ever in the history of mortgage rates have they doubled in a 6-month period. To give you an idea, the impact mortgage rates have actually on the mortgage payment, a $300,000 mortgage payment with a 30-year let me rephrase that, a $300,000 mortgage on a 15-year payment schedule at 3%, $165 a month. If you raise that to 6%, it's $1,800 a month. That's a 43% increase. So your payment doesn't double like the rate does, but it is a 43% increase, which is very significant. And you would think that has to affect the price of housing.
Yeah, it basically impacts affordability a ton. So it's something to consider, and that's going to be one of the factors we're going to talk about that really is pushing, the prices down. But we have some other supporting factors that are helping to push the price up. So we're going to talk about that in a bit more detail. But the first thing we wanted to dive into is kind of where we are with mortgage rates relative to where they have been historically. You want to talk about that?
Surely. Over the last 70 years, we look back 7 years to see where rates have been. And if you remember, I said mortgage rates have never been in the twos or the very low threes. Going back to 1951, mortgage rates at 4%. 10 years later, in 1961, they were at 5%, and 71, they were at 7%. So we're seeing a steady growth or increase, I should say, in interest rates. But in 1981, we took a turn for the worse, and that is when we hit 16. Actually, it was 16.63% was the highest mortgage rate, I believe, recorded, and as an average, as a national average. And so we started to look at what was happening during the time in 1981. And that's when we were going through the oil embargo. We were still dealing with high gas prices, and we were suffering from very high inflation. 10 years later, by 1991, things started to settle down. Oil prices were much more in control. Inflation was surely in control, and rates had come down to 9%. They had fallen into single-digit territory, and we were all celebrating. And I remember I got my first house in 1985. I was able to get an 8% mortgage through an inside arrangement back when rates were 12 to 14%. And I was ecstatic at an 8% rate. But here is 1991, you're talking about 9%, 2001, 7%. And just last year, we were down to 4%. So we went from 4 to 9. Now we went from 9 down to 4. So we see where this is going. We tend to work in cycles in the financial sector. And what's happened now this year, as we said, in January, went from, I'll use round numbers, 3% to now roughly 6%. What's happening now that's causing this problem? Well, we're dealing with an oil shortage, and we're dealing with high inflation. Sounds familiar. 1981, oil shortage, high inflation. But are we still as concerned? Do we still think we are going to see double-digit returns, double-digit? We don't think so. So the question is, where will they go? How high will they go? What's different now versus where we were in 1981, where mortgage rates went from 4 to 16% in a matter of 40 years? Again, we were 7 to 16% in a matter of 10 years. And quite frankly, it was late 70s when rates were rather normal until the early 80s when they skyrocketed to 16%. So do we see over the next few years some ridiculous, untenable interest rate like that? And the answer is we don't believe so.
Yeah, I think just from a political standpoint, no one in the executive branch would let it get that crazy because there's no way they would get reelected. Everyone would be, up in arms. But I think the most important kind of thing to take note here is that the interest rates are definitely going back up. We all know that, but
Yep.
we've really been spoiled for the last while, really, with these extraordinarily low interest rates.
Right.
Because when we look, over this period of time, three, those numbers, even four, are like pretty unheard of over the course of the last 70 years. When we look at the average, it's much more about six. So although this feels really high right now, this is really a much more normal number that we're looking at.
Absolutely correct. Um, I was talking to a homeowner this week. I think it was just 4 days ago. And he said to me that he's looking to buy a house shortly. He's not concerned about the high interest rates because he figures in 3 or 4 years he'll refinance at around 3%.
Yeah.
And I was trying to explain to him, do not make a purchasing plan based on mortgage rates dropping back to 3%. I think that's a losing man's bet.
Yeah.
There's no reason nothing to support that. What do we see? So we're looking at the trend lines of what we've seen in the past versus what we see now. And and if you look at the trend lines, again, they inched the way up. We had a spike. We came down to normal, past normal, and we're working our way back up again. Again, if you look at the stock market runs in cycles. The interest rate market's going to run in cycles. It's no different. It's all part of the same economy. So what's going to make this, though, environment any different than in 1981? We have oil prices are skyrocketing and inflation is out of control. In 1981, 80% of our oil came from OPEC, not a very friendly environment to the US. And that was of tremendous concern. They controlled the oil for us. Today, we get about 6% of our oil from OPEC countries. We're getting most of our imported oil from Canada and Mexico, much more friendlier countries to us than OPEC countries. So I feel that this oil problem is also a function of COVID and a function of lower drilling. But as we start to move away from being a little less oil dependent, I think that will have an impact as well. But that's a long-term impact. On the short term, I think supplies will get back to normal. And I think we're going to see oil prices come back down. Right now, we're hovering at $5 a gallon. As a matter of fact, I think today it came down about 5-6 cents nationally, which is a huge swing historically. So I think we'll be okay there.
Yeah. The interest rates, I mean, the Fed's already announced, over basically the remainder of the year and probably going into at least the beginning of next year, that we're going to see consistent, additional rate hikes. And in fact, the last couple of rate hikes that we just got were some of the largest in almost 30 years.
Right.
So that's significant. So the real question is, how is all of this going to affect the housing market and housing prices? Because on one side, we have now houses that were very affordable when you look at the monthly payments. And all of a sudden, those monthly payments have now just risen by close to 50%. So that makes something that was affordable really no longer affordable.
What's interesting, Ben, let me stop for a moment.
Mm-hmm.
In this late 70s to early 80s, when we had that skyrocketing interest rate, I was in college at the time, so I wasn't so aware of mortgage rates and so on. I was aware of them, but not housing prices relative to mortgage rates. So I did some research when we were preparing for this. And quite frankly, the housing prices in the late 70s and early 80s did not drop. Even with a 16% mortgage rate, they did not drop. Because again, there's more factors that determine housing prices than just mortgage rates. And if that's not proof, I don't know what is. They were going up steadily, then they sort of leveled off to a very moderate increase on an annual basis, but they did not drop. And I would have told you to expect a precipitous drop with those kind of rates. But the economy was strong enough to support it. People's salaries must have been going up at the time and so on, that they were able to afford the extra the extra monthly, extra dollars in their mortgage payment.
Right. Yeah.
It's all about disposable income.
And one of the other factors there that I think in this situation, and possibly in that situation, kind of helped keep things, stable, is that we've been running at a housing shortage. So it's currently estimated that there's about basically a 2 million housing shortage supply.
Right.
Meaning we're not building homes fast enough, and that deficit is actually growing year over year. So again, while we have one factor pushing things down, the fact that demand is outpacing supply and growing that way is something that's constantly pushing on the other angle. And we have a lot of new millennial buyers who are entering the buyer pool. They represent over 40% of new home buyers. And this is a kind of a market that beforehand was not really buying homes. And I myself fall into that category. And I haven't purchased a home. I'm looking to, in a few years. And even though we buy tons of homes every year,
That's right.
having one for my personal residence hasn't been a priority or something important to me. And so eventually I'm going to settle down and buy a place. And, as people my age continue to, settle down and purchase more homes, that millennial buyer pool is going to be larger and larger. And they have particular needs and wants,
Yes.
or I'll say more wants.
Wants. Yes,
not a
I was
need.
going to say that. Yeah.
Which is that they're really looking for turnkey homes. So the demand for renovated, move-in ready, updated properties is even more in high demand, because it's going to these buyers that are looking for such a thing.
I joke all the time. I'm not sure it's so funny, actually, that if we could never be in this business in the 1960s, people were moving out of the city into the suburbs, especially here on Long Island. And people were handy. They did work themselves. They'd buy a house, they'd fix it. And so my father-in-law dug 4 dry wells in his yard for the downspouts. Nobody does that anymore. People don't even paint their own homes anymore for the most part. They don't mow their own lawns. Landscapers wouldn't really be in business in the 1960s. Everyone had a lawnmower. Today, no one does those. Few people do that. And I've succumbed to that in the last couple of years. I mowed my own lawn until just a few years ago. I gave in. But as a result, a business like ours, so we buy houses that are in disrepair. We buy houses in all condition, but excellent condition to poor condition. But there wouldn't be the market for us to be able to buy these houses, fix them, and sell them, because people would buy them and fix them themselves. So I'm glad you millennials are buying houses in one turnkey, because it keeps us in business.
Yeah. And going back to the supply side of things,
Yes.
We don't see that, changing too soon, especially these days. Ever since COVID, the builders have been plagued with extremely high material costs. And we know this very personally. Material costs have risen about 19% last year. And that typically represents about half the cost to build a new home. So what you're really looking at is an overall 10% increase in just the raw cost of building a property.
Right. One of the ways we make money when we buy a home, when we do a renovation, we work at about half the price of retail, because we end up renovating so many homes a year. We give contractors an enormous amount of business. Some of our contractors, we're their only client. And as a result, they work for us less expensively, and we bought our materials in large quantities. For instance, the manufacturer's offering a great discount on Samsung appliances. We'd order 20 sets of appliances, 20 kitchens worth of appliances, and keep an inventory. Now we can't even get a complete set of Samsung appliances for one house.
Yeah, it's
we
crazy.
have to mix and match different brands. They're just not available. That's becoming a problem.
Yeah, and the other issue that builders and contractors and whatnot are facing is supply shortage. A labor shortage.
A labor shortage.
Yeah.
Yep. And the price of labor as a result has gotten very expensive. Labor, supply and demand, just like materials. Matter of fact, a friend of ours is a builder, and he said he's going to retire. He's finishing up his project and going to retire because he can't get the help, which is putting behind schedule on jobs, making his clients very unhappy, and it's causing tremendous stress. So as the material costs he can work with, he builds the increases into the price of his price of his projects. And if prices go up, his clients know they're going to get an increase as well. Some of our contractors do the same thing to us, I should say. But it's the labor shortage that's the real problem. You just can't get people to do the work. And another issue we're facing as a country is we're not training people and educating people in the trades. We're not training people to become carpenters and plumbers and electricians. And it's going to be a sorry day. We're seeing it now, but I can't imagine 10, 15 years from now, it's got to be worse. It's just got to be worse.
Yeah.
Unless demand goes way down, but that's cyclical, but not training people is not cyclical.
Yeah, but the demand isn't even particularly cyclical because we have this 2 million home deficit already, right. So it's just we need to be building homes at a greater and greater rate. And, part of that is also where the homes are being built. So as, right. Everyone already knows that people in New York moved down to Florida. But that was even exacerbated during COVID, where people from the north were moving to states like Florida and Texas, Arizona,
right.
And the
Carolinas and Georgia.
Market, yeah, and the real estate market in those areas, if you think it grew a lot in New York over the last couple of years, you take a look at what's going on in Florida. It's crazy.
It's almost straight up. So on a graph of price increases, it's outrageous. A matter of fact, the price of a new home is not as high as the price of a resale in Florida because people want their homes today. They're afraid of waiting a year for the new home to be built because they don't know what mortgage rates are going to be like. They're willing to take an older home. Old is a relative term, but take an older home just to avoid having to wait to get the newer home, even though the newer home traditionally had more value. They're just desperate to get down there. A matter of fact, New York has lost 1.5% of its population, and Florida has gained 1.5% population. I think everyone from New York who moved must have gone to Florida. It's the exact same percentage. And I believe that percentage is very heavily concentrated in the southern part of the state, Westchester, New York, the boroughs and Long Island. So we're losing people at too high a rate on the island, and that will have to start having an impact on housing. Back to supply and demand. While we still need to build more houses, as demand decreases, we'll need to build fewer houses. So again, as you can see, there are issues that are going both directions. Reasons prices should be going up, reasons prices should be going down. It's a push me, pull me kind of thing, but there's still more to discuss. Yeah,
and talking about kind of Florida versus New York for a moment, the interesting thing that you see happening in Florida is these new subdivisions that are getting built with, hundreds or thousands of new homes in one development. And that's happening all over the state. You don't see that in downstate New York. You don't see that on Long Island. There's just not the land. There's not the space for it. So, when we're talking about what might potentially happen to housing prices, in the downstate New York area and the Long Island area, one of the kind of bolstering factors, again, going back to supply and demand, is just space, right? Yep. There's not enough room to build much more. And they're building, tons and tons of houses down in Florida. You can't even do the same thing in New York if you wanted to. So that limited supply, there's almost like a cap on the supply available in New York relative to what you see in states like Florida, Texas, Arizona, where a ton of the state is underdeveloped.
Correct. They're building subdivisions with hundreds of houses. I looked to buy in North Carolina. They were building, I think, 2,000 houses in one subdivision, and there were probably 6 subdivisions going on within a few miles. Mm-hmm. So, New York, if you buy a find a 4-house subdivision, a 6-house subdivision, a half-acre lot you divide to 2/4-acre lots, and that's kind of building for the most part we're seeing on Long Island. Every now and then they'll find a piece of land that, where was that? And you suddenly see 12 houses go up, 15 houses go up, but that's it. You're absolutely correct about that.
Yeah.
The land, very, very, very scarce on Long Island, available land to build, without a doubt.
Yeah.
We have a whole nother, go ahead, I'm sorry.
Go ahead.
That's going to be a whole nother issue here, and that's unemployment. Unemployment is incredibly low. Right now, we're at 3.6%, where the 70-year average is about 5.75%. This is giving people money. More people are eligible for mortgages and able to buy homes as a result. Once again, a reason to think prices will be on the rise in spite of rising mortgage rates. Another thing, in 2022, this year, we're seeing this tremendous inflation. We haven't seen inflation for a long time. So the cost of living on all of our expenses is going up: food, fuel, as we talked about before, and so on, heating oil. And that, as a result, we're going to start seeing people with less disposable income maybe start turning up credit card debt, which will increase their debt to income ratio, which can reduce the chance of housing prices going up. So there is not any one direction we see housing prices go. There's no one factor that's going to determine the direction of housing prices going.
Yeah,
So,
it's like almost the more you look into the subject,
right,
the more like conflicting forces you see. And so
right.
the question is, what do we think is going to happen? What is the general consensus about what's going to happen? And basically, our thoughts and general consensus seems to be that there's not going to be some major crash like we saw, 15 years ago.
Are we talking nationally, or are we talking Long Island, New York
Well,
specifically?
let's talk Long Island first.
Okay.
I think Long Island, as we were kind of explaining before, is a bit more insulated. We didn't see the crazy, insane growth like some of the areas in the South.
It
Although,
seemed like we did until you compare it to the South.
yes, right. And dollars wise, we saw big increases, because if our average house is $500,000 in Nassau County, and that house goes up by 20%, right? That's $100,000 increase, but it's 20%. Whereas if you have a house in Florida that goes up by 80%, maybe it's a $200,000 house, and now it's a $360,000 house.
Right.
So it's still, for many New Yorkers, it's still seen as affordable and whatnot, but the percent change, which is really I'll say the red flag as like a risk factor for a correction. It's much more about the percent change than it is about the dollars.
Absolutely. So New Yorkers who are retired going to Florida are still getting a bargain even at the high price. Doesn't mean that it's not going to be a correction, but they're still getting a bargain. It's the millennials, the working age people, or the people living in places with the same kind of economy as Florida, as far as earning potential and so on, or who actually live in Florida. Those are the people that are getting pummeled by the increase in rates. If I'm going down there with my Long Island income and I'm retired, it's going to go a lot further down there, as you said. House is now 360 versus 600 up here. There's still a big gap, and the property taxes are way lower. So for us New Yorkers, it's still a bargain. Not as much as it used to, but still a bargain.
Yeah, and some of the other things you think that are going to change is that inflation will slow down a bit. There's two major factors for the inflation that we have at the moment, which is one, we printed a ton of money during COVID relief.
Yep. And
the second one is that COVID caused tons of supply shortages, whether it was, on the production, the supply chain side, and ultimately down to the retail store. And that's causing prices for, everyday goods, building materials and whatnot to rise. So that one we should be able to see a correction on much sooner than, the adjustment of the new money supply. But there is going to be a normalization on the production and supply chain side of things.
Yes, absolutely. Absolutely. So with the Fed's, if they start to reduce, as inflation calms down, the Feds will stop increasing the Fed rate, which will keep the mortgage rate from continuing to go up. And that's the key. As you said, the expected continuation increase in prices will moderate as the supply chain becomes a non-issue and inflation starts settling. Material shortages should get better again as we get out of this COVID period. That should be a big help. And the low unemployment, we believe, will continue, but we'll have a twofold effect. We're going to maintain demand because as people are working, they want to buy homes. The higher the unemployment rate, the fewer people eligible to get mortgages and buy homes. So it's going to keep our inventory low because the demand is still going to be high as we maintain this low unemployment, this low unemployment period. So again, another factor. And as we said, inflation, and I think home buyers, Ben, I think you'll agree with this. Home buyers are probably become accustomed to a 6% mortgage rate again. Right now, we're looking at it in horror. But as we get used to everything, we're going to get used to $5 gas. So it'll become a bargain, even though they're only $2.50 a year and a half ago. Mm-hmm. It's just a matter of getting used to it. And 6% really is a normal settling point, 5.5%. And I think we're going to end up there in the next few years. I think that's a big part. I think a lot of home buying is psychology. It's just psychology.
Yeah. So one other thing we actually didn't touch on, which is as people have gotten locked in over the last number of years to low interest rates and affordable payments, those people are going to be less likely to move, because even to move to an equally priced house at this point in time is going to be much more expensive to them. So again, going back to supply and demand again, when we're talking about now supply of houses available on the market is going to be lower. We foresee fewer people, moving and transacting in real estate. And therefore, if you're a buyer, you're going to have fewer selection, fewer choices, and that's going to help maintain the price on the seller side.
That's very true. That's very true. Right now, again, here on Long Island, downstate New York, we're seeing what historically happens. When the market's about to have an adjustment, a change, and usually negative change, it's the high-end houses that are the ones that show the change first.
Yep.
We're seeing the luxury markets, houses sitting on the market a little bit longer. Prices we're not selling for over ask. Prices are starting to moderate. And that's sort of like the canary in the coal mine. So I think that's a sign, good, bad, or indifferent. If you're selling, a bad sign. If you're buying, a good sign, that prices should be moderating. So with all the things we've said up until now, we're going to resort to the canary. And that is the high-end housing market is starting to show a shift into more moderate growth or even some decline, depending on specifically where you are. Conversely, higher interest rates actually price out the lower-end buyers. Now, higher-end buyers may choose not to buy the more expensive house, but the lower-end buyers are unable to buy a new home, move from the rental to their first home, or move from their starter home to the next home. They just can't afford it. As we said, just this 3% shift in interest rates increased the mortgage payment by 42%. So that becomes a problem. So we haven't seen that yet at all. Lower-end housing prices are still going up, and they're going up at a reasonable rate. Again, the canary in the coal mine is the high-end houses, but we're going to see this come next, I believe. So with all these considerations, what are we predicting? We're not predicting a crash like in 2008. We don't think that's going to happen. As we said, there's too many pluses and too many minuses. There are too many things in the housing market will still be strong column for it to see a crash. And we think they'll moderate over the second half of 2022 and through 2023 with little risk of a crash at best, little risk of a crash in the Northeast. The Southeast, Texas, Arizona, we're a little bit more concerned. They're still getting population growth. And my own brother just moved from New York to Arizona. And they're going to still hold strong due to the population growth, but the prices have gone up so much. It depends, again, on the affordability factor. If non-native Arizonians, if that's the right term for people who live in Arizona, or Floridians and so on, keep moving down there from high-end locations, that'll help. But their prices are so far out of whack. If you just look at a normal housing price curve and it just goes straight up, it seems impossible to think we're not going to see a decline, and a significant decline in that market. There's too many things to support it, but the price increase was so high and so fast that we don't believe it's going to be supported, and we don't believe it's going to have the same fate as the Northeast, and we think they're going to suffer a significant decline. I think Florida probably being the worst of all of them, in spite of the fact that they're gaining ground on, again, on employment and on population. I still think they're in for a rough road going forward. It's going to be this year, next year, that I'm not predicting so fast. I don't think this year, but next year, maybe.
Yeah, but even I'll say in the Northeast, where we think the prices will be pretty stabilized, it is still important to note that with the interest rates are going to go up, in the short term, and we know that's happening. And with each rise in interest rates, your purchasing power just gets eroded. You can now afford, less house. And so if you are looking to buy or sell, in the short term or the midterm, you probably want to do that sooner rather than later. We were talking with a seller who's been kind of wavering back and forth about whether she wants to accept our offer. And during just the few months that she's been debating this, she's lost about $50,000 of purchasing power in terms of what she can afford to pay for her new house, because the interest rates have changed so drastically.
Right. Her house probably appreciated by maybe $5,000 in a short amount of time, maybe. But she lost $50,000 of buying power, as you said. It was bad math. And we're trying to push her to move forward, not for our benefit, but for her benefit. And numbers don't lie. These are just the numbers. So while none of us have a crystal ball, we've done quite a bit of research to find out what to anticipate where we think the market's going. We thought it'd be very interesting for people watching this video. And it's also very important for our business, since we're in the business of buying real estate. Any parting words from you, Ben?
Well, if you have a house to sell, we'd love to make you an offer. If you want to give us a call or reach out to us at leavethekey.com, we'd be happy to help you in any way we can. Thank you.
Thank you.